The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Equity investors walking that sentiment tightrope as technical dip buyers rushing back in. Studio 2 at Bloomberg headquarters in New York. I'm Romaine Bostick.
And I'm Alex Steele. Do I say dead cat bounce?
Please don't. Leave the cats alone.
Leave the cats alone. I do love cats. I got to be honest with you guys. All right, just take a look at the markets here. It's really not necessarily only about tech. The Mag 7 is up 0.7%. The S&P is up 0.9, but it's really the equal-weighted index. The other 493 stocks that are doing particularly well, Romaine, that equal-weighted index up by over 1%.
Yeah, and the heavy lift in equities really coming today from who else? NVIDIA, Amazon, and Microsoft. Big cap, big tech, leading the charge of, Alex said, almost 500 of the S&P 500 components. In fact, right now, about 95% of that index is poised to post a daily gain, which would make this September 9th the broadest rally the S&P has seen since November 14th. And that's an important date because that was when data showed an unexpected slowdown in U.S. inflation that really had markets confident that the Fed's 4-month pause in hiking rates would prove to be the end of the tightening cycle altogether. And they were right. But now, 2 years later, the markets are betting on Fed easing. Craig Johnson, the chief technician at Piper Sandler, calling it a sentiment tightrope between Fed rate cut cheer, recession fears, and a political wonderland. But he does say that his analysis suggests last week's market slump was a temporary pullback from a larger term uptrend. But amid the rebound today, when you take a look at those 30 or 40 stocks that are in the red, Apple is one of them, not participating much despite a splashy product announcement for new iPhones that Tim Cook says are, quote, designed from the ground up for Apple intelligence. Investors not quite on board yet. UBS analyst David Vogt explains why.
So we need to see a much more robust ecosystem over the next 12 to 24 months. And the challenge that Apple faces is this is the first product that they've launched in history that I can recall that's beta version and doesn't have all of the features at launch. So they're going to be waterfalled in over the next 12 months or so. So it really doesn't give the consumer really anything to grab hold of and say, I need this device today.
That was David Vogt over at UBS speaking earlier. Joining us right now to help kick us off to the close is Gil Luria, senior software analyst at DA Davidson. And we've seen the phones. We knew they were coming. We knew they weren't going to include the AI features immediately. Do you think that's going to hamstring the potential upgrade cycle on the hardware devices?
I think it spreads the upgrade cycle over more of a 12 to 18 month period where maybe coming out of Worldwide Developer Conference, when we saw these features, we thought they'd all be in the iPhone 16 at launch. We thought iPhone 16 itself right away over the holidays, the fourth calendar quarter, would provide the big upgrade cycle. It's becoming increasingly clear that they're going to layer in the Apple Intelligence features, which means an upgrade cycle that would spread over 12 to 18 months. That doesn't change the fact that this is the biggest upgrade cycle since iPhone 12. And stock-wise, let's not forget, the last time the stock worked was after iPhone 12. So we've gotten 15% outperformance out of the stock since Worldwide Developer Conference, taking a little bit of a step back today as we wrap our heads around how long it's going to take to get this upgrade cycle going.
But just to kind of play devil's advocate here, I mean, this is a big upgrade cycle, but part of that is because that cycle got longer. A lot of people looked at their phones, they looked at iPhone 15 or 14 or 13 and said, I don't really need to upgrade. I can stick with my 12 or 11 or whatever. Or if you're in the case of, my parents, like the iPhone, 2.
At least they have one.
Yeah, at least they have one, Gil. But I mean, it gets to this idea here that what's sort of the sense of urgency that I guess used to be sort of omnipresent around these Apple product launches events. Have we lost that?
We'll get the sense of urgency as these features come out. So first of all, the one push camera, the one press camera will be a relatively innovative feature in the context of the last 4 years. But it really is the Apple Intelligence features, the summarization, the prioritization, the organizing memories, the allowing Siri to take action. Those are new things that as they start working into our regular workflows, people will notice them and have that FOMO when they see their friends and family using these features to do things that were previously not possible. Mm-hmm. This is one of the nice things about what Apple does is it takes technology that's revolutionary and it incorporates it into what we already do. Some of these features, functionality already available around tools like ChatGPT, but you have to take them outside of what you're doing to get the benefit. If the automatic writing, the image generation, the summarization, the prioritization happens within your experience, you'll notice it, you'll be delighted, and again, you'll start proliferating those thoughts and excitement to your friends and family, which is what gets the upgrade going.
Okay, Gil, so how do you calculate, though, a spread out super cycle into valuation?
So it's not spread out into more than 12 or 18 months, meaning our forecast is for iPhone to grow 10% the next fiscal year. That's still the forecast. Whether it's a little later in the year, a little earlier in the year, that would be the biggest upgrade cycle since iPhone 12. And expectations are for a much smaller, for maybe a single digit, maybe even mid-single digit growth. So we think that in the next fiscal year, there will be 10% growth in iPhone, which, let's not forget, is half of Apple's sales, more than that in profits, and pulls the other categories. It pulls wearables, it pulls services. So that's the acceleration Apple needs to its growth and profitability, is even if it takes a full year to do those upgrades as opposed to being more concentrated on the front end.
And then how does then China play into it? I mean, there's so many issues there. Are these kind of upgrades and the AI potential enough to get Chinese consumers in to buy, or can this be this 10% growth in sales without a strong China?
China is going to continue to be a wild card. And in China, this functionality is more table stakes. The native competitors there are going to introduce similar functionality, and there's less of a brand pull in China for Apple than there is in other parts of the world. So China will continue to be their toughest market, their most challenging market. They have to make up for it in other markets, specifically maybe in India.
All right, Gil, always great to talk to you. Gil Luria, Managing Director and Senior Software Analyst, jumping on over at D.A. Davidson, jumping on with us here to kick off the show. Of course, a closer look, Alex, at that unveiling of these new products. And it's really all about the software, the AI capabilities that are going to come down the road later. And there was an interesting story about Amazon, another big tech heavyweight, also experimenting with AI, but this time with Audible books. And I like audiobooks. And I'm actually one of these people that I actually will deliberately seek out books that are read by certain people. Yeah, because certain people just have a certain, it's just more pleasing to my ear, and I like them. And now they're saying, well, maybe we can mimic this through AI.
Yeah, so basically, US-based audiobook narrators can help train artificial intelligence on their voices. And you basically make clones. So now all the books that you want could be read in this author and audible voice that you like.
I assume with the permission of that.
I'm assuming they're getting paid for that. They're trading
you assume. I don't know. It's this big tech we're talking about. So.
It's true. But, funnily enough, I knew a lot of actors who made, like, boatload of money through audiobooks. And this was, like, 20-plus years ago. So imagine what it could be now.
I know voice actors, and it gets a pretty lucrative gig here. I didn't ask you, though. Are you getting a new iPhone 16?
I am not.
No, but did you see all the pretty colors? It's not just, gray and black anymore.
No, I kind of want the teal, but I kind of don't want the teal. Like, I like it and I hate it at the same time. I don't know what that means.
They have a pink one, too.
They do have a pink one.
But I guess they've always kind of had pink, right? Some version of pink.
I have lavender, not
lavender.
Pink. Yeah, but the pink's a little aggressive, I think.
A little aggressive?
But I'll do blue. We do the blue. It's pink.
All right, we'll be back in a moment here. We are keeping an eye on the markets, and one Bank of America strategist ripping off Aesop by suggesting to prefer the tortoise to the hare. Why she says utilities are the safe sector and the political uncertainty ahead of this year's election.
I like the tortoise. All right, speaking of the election, tomorrow Vice President Kamala Harris and former President Donald Trump go head-to-head in the first presidential debate since President Biden dropped out of the race. We're going to walk through the big issues the two could butt heads on, especially when it comes to economic policy.
And first it's debate night, then it's fight night. Alex, I know you're up for this. The UFC CEO, Dana White, he's going to be joining the big program in just a second ahead of a big matchup at the Las Vegas Sphere on September 14th. My hotel actually overlooked that last time I was in Vegas, and it kept me up all night. This is The Close on Bloomberg.
On September 10th, as Election Day approaches, Vice President Harris and former President Trump hit the stage for the first time.
Oh, we're going to beat her. I look forward to the debate.
If you got something to say it to my face.
We'll bring you informative analysis.
Will that debate decide the outcome of this election?
It's going to come down to both policy and performance.
Tune in to Bloomberg Television for the ABC News presidential debate simulcast with special coverage starting at 8 p.m. Eastern. Context changes everything.
On these pullbacks between now and the election, step in, buy the pullbacks.
That was Joe Quinlan, Maryland Bank of America private bank head of CIO market strategy. Let's take a look at where we are right now. Dip buying seems to be the word of the day. You got the Nasdaq just up by 0.6%, but the S&P outperforming up 0.8%. Let's bring in Andrew Slimmon, senior portfolio manager and head of applied equity advisors at Morgan Stanley Investment Management. Andrew, do we buy the dip, or is this just sort of a little bit of a rally and a downtrend?
Well, I think you're right. What you said before, which is a dead cat bounce. It was a pretty bad week last week.
Someone also likes my dead cats. Okay.
I think you're right. I just think it's still early September. It's way too early. The market is barely down from the high. We had a pretty nasty correction in August, and usually you get reverberations that are more than this. So, I think your guest, Joe Quinlan, was before, buy the dips, but I think it's a little bit premature. There's a lot of things, uncertainty right now. I think we're going to get a rally towards the end of the fourth quarter, but it's too early.
So what do you need to get through? Do you need to get through the election? Do we need to get through the Fed cutting cycle starting until you can have more conviction to buy?
Possibly, or maybe just more of a decline, right? And I think, but keep in mind, anytime stock prices diverge from fundamentals, it creates opportunities, and that's what you want to see. So I think the economy is slowing, but it's not breaking. I think the high yield market would be telling you bigger problems. I think you'd see some of these cyclical areas rolling over if there's a deeper problem. But in short term, the stocks are a popularity contest, and I think they're unpopular right now. And that, for a portfolio manager, creates a wonderful opportunity, right? You want divergences between fundamentals and stock prices.
Well, but how much further do we need to see some of those prices come down to kind of match, I guess, the appetite people would have? They would look at some of these stocks and say they're a bargain, because we had a pretty massive sell-off in some of these names, and names that are going to rebound.
Right. Yeah. Yes, that's true. But if the overall market is weak, it's going to pull the big names down. In my experience, and you know this as well as I do, is when people sell, they sell their winners, right? So I wouldn't, you're getting a bounce in the AI names, but I think you're going to get a better shot at them maybe into October, into the election. It's just we're seeing a kind of a traditional, kind of September, which I find incredible, because if everyone knew it was going to happen, how come it's happening?
I know. And it gets to the idea, too, of we talk about market catalysts, and there's plenty. We've mentioned the election. Obviously, you have a big Fed meeting next week. And I'm wondering how much that Fed meeting could potentially reshape the market narrative. I know everyone kind of knows what's coming, or they think they know what's coming, but there's still a communication aspect to that meeting that Jay Powell's going to have to navigate, that the market's going to hinge on explicitly.
True. That's true. But if I had to think about what would be the catalyst for further weakness, it's maybe continued softer economic data that creates that anxiety that, maybe it's not a soft landing, maybe it's more of a hard landing. I don't think the inflation number on Wednesday is going to cause a weakness. I suspect it's going to be further kind of weakening the economy, creates that jitters. But I don't think the Fed, this is a good thing. They're easing off on rates. That's going to help kind of risk assets in general. So you could get a continued bounce this week.
What do you think neutral is, and how does that matter for someone like you? Neutral rate for the Fed?
Well, it matters that the risk-free rate is coming down, and that's really important to consider, because if you think about kind of high growth stocks or small cap stocks or anything that has high growth rates, and then you discount back to come up with a current valuation, well, the risk-free rate went up, and that hurt kind of present value on assets. And now if the risk-free rate's coming down, that'll help. So I expect small caps to bounce, high growth stocks to bounce, anything where you're looking out a few years to figure out what they're going to earn. That's going to take the pressure off those stocks, at least short term.
Do you think all of this comes with a pickup in volatility that kind of stays?
Yeah, I mean, you always get, what's interesting is at the beginning of the year, I was saying, well, these two candidates are running. We know what we have, so I think actually there'll be less volatility this year. Now that we don't have both candidates been president, it creates more volatility. That's the norm. So yeah, I think there will be more volatility, which is not a commentary on one candidate or the other. It's just that one candidate is unproven and one we know, and that creates more volatility. volatility. So that's another thing that could cause some weakness.
So does this, though, get us to that potential for a rally scenario at the end of the year? The idea that once we get to the election, we know the results, then investors, in theory, and by that time you'll have a Fed that in theory will have also laid out its roadmap to a certain extent. I mean, I know that's not all clear, but at least you have clarity.
Well, that's exactly right. And that's my point about where the fundamentals diverge. Because what's fascinating here is at the end of the year, the market is going to be priced off next year's earnings. And there's two types of earnings estimates. There's a top-down from Wall Street, and there's a bottoms-up that are all the analysts and what they come to. Well, that number for next year has been going up, up. So that means companies are guiding analysts to a good year. And that's very, very healthy. And that divergence between the bottoms up and the top down is very wide, the way it was last year at this time. And what happened is Wall Street strategists had to kind of chase the market higher into fourth quarter.
Do you think they're going to be
smarter? And I think that's going to happen again because, when I talk to companies, when we listen to companies, they say business is pretty good for the most part, cumulatively. So I think once we get through this macro and people say, okay, what are these companies going to earn? How are things looking next year? Oh, it's pretty good. And that's when we get back to the micro at that, the earnings. And that's when I think you get a rally.
Will the earnings though hold up? I mean, we're heading into, in theory, what earnings season, I guess, in about a month's time or so?
Already?
Exactly. Exactly.
I know. Sorry to shock you.
But if they were going to be weak, you would have heard by now. Companies would have already called. So I think called and said, you might want to lower that number a little bit. So I don't think that's going to happen. And I don't hear that either.
Well, I mean, it's interesting also, like you're looking at a Fed cut world too, which is really different than before. So we'll see how that plays out as well for their outlook. All right, Andrew, thanks a lot. Really appreciate it. Andrew Slimmon, Senior Portfolio Manager and Head of Applied Equity Advisors at Morgan Stanley Investment Management. Romain?
All right. He was, of course, just talking there about the volatility that we could see between now and maybe through the election here. The VIX slightly lower here on the day, but with that election just months away, Bank of America says policy uncertainty will bring with it that elevated volatility, and it will make one sector in particular far more attractive relative to its growth peers. I want to bring in Jill Carey Hall, U.S. equity strategist and head of U.S. small and mid-cap strategy for Bank of America Securities. You're not buying the tech dip, Jill, but you actually see some opportunities, and I guess I'll just call it this, maybe a little bit more of a boring sector.
Right. So, the utility sector is one that, may tend to be forgotten. But when you look back since the 1980s to now, it's actually surprisingly seen similar total returns to the NASDAQ on an annualized basis. So sort of a tortoise and the hare. And we do think in this backdrop of elevated market volatility, uncertainty ahead of the election, macro uncertainty, that this is a sector that looks attractive. We think you want to own quality and yield in this environment. So we did raise the sector to overweight this week. We think that's one where, as you have volatility likely to pick up in the months ahead of the election, which is what we typically see. Macro uncertainty, as I mentioned, also the slope of the yield curve has tended to be a good long lead signal of what the VIX does. And that's also been suggesting that volatility was likely to bottom midway through this year and could continue to rise.
Well, it's interesting, too. I mean, as you were speaking, we just put up a chart of how utilities have performed year to date, up about 20%. When you talk about the potential for yield, the potential for return, let's just call it that here, you're already looking at an index that, at least on an annual basis, has kind of reached the pinnacle of, I guess, what we've seen historically. I mean, this isn't an index that typically moves, 30, 40% in a year. A 20% gain would be great.
Yeah, I mean, I think, we're in an environment where our view on the S&P 500 overall is essentially pretty neutral at this point. We have a 5,400 year-end target. We think more of the shifts are going to be within the internals of the market. So we're underweight tech. We think that's a sector that's still expensive and where some of the earnings growth that we've seen now may start to shift out of, Magnificent Seven into other areas of the market. Utilities has outperformed this year. year. But, I think we're in an environment where even though higher quality stocks have started to re-rate, we think that may continue. We were in an environment for a long time where investors were sort of doing the opposite of one might expect based on traditional finance 101. Low quality stocks were trading at a premium to high quality stocks, which would be, earning stability and safety. So sort of the opposite of what you would expect. So we think it's, more of a normalizing environment. Dividend payout ratios for companies, which are at all-time lows, should start to tick up, and more of total returns could come from dividends going forward.
Jill, for the utility sector, do you think that there is a growth case to be made? And I appreciate what utilities typically stand for, but some of the stocks in the utility index for the S&P are stocks like Vistra and Constellation Energy, and that's a straight-up data center power play.
Exactly. I do think that there are growth aspects to the sector. We think that some of these are, related to many of the key themes in terms of AI and data centers. So certainly there could be that growth aspect as well. And then the sector, does offer very attractive dividend yield in an environment where if the Fed is cutting rates, which we do expect to start happening this month, equity income becomes increasingly attractive. And there's obviously a lot of secular case to be made for equity income, retiree money shifting out of, those shorter duration investments into equity yield, which offers inflation protection.
In your note, you also talk about lowering energy to market weight, and you say it goes from value to value trap. Why is it a value trap now?
So the sector's still historically inexpensive, but we've started to see earnings revisions come down. So that makes the sector look more like a value trap than attractive value if estimate revisions had been coming up. Our commodity strategists have sort of lowered their oil price outlook recently. And energy is obviously a more cyclical sector. We've seen some weakening in demand trends there. So one of the macro indicators we track, our U.S. regime indicator, has started to weaken for the past 2 months. So overall, we opted to upgrade utilities, which is obviously a more defensive sector, and downgrade energy.
So when we talk and kind of put this together for us, Jill, because there's been a lot of discussions about this idea that there are still people on the sidelines that are waiting to jump back into big tech or whatever is sort of the big trend sort of following trade. And is there a sense here that maybe if there is a sort of another big leg to this bull market cycle, it will indeed be a lot broader than what we saw kind of in 2023 and then at the start of 2024?
Right. I mean, usually when you've had periods of such a narrow market, the reversion would suggest that you do see a broadening out. And that's what the earnings backdrop would tell us, where, for a while, big tech and the Magnificent Seven had seen much better earnings growth and upside surprises to results for many quarters. And now, that trend is starting to reverse, where, the other 493 stocks within the S&P 500 are starting to see earnings growth tick up. Magnificent Seven stocks, many of them are starting to spend on CapEx, many of the big hyperscalers pretty significantly, where their earnings growth should slow. So that would argue for sort of a broadening out of the market. We had preferred the equal weighted S&P to the cap weighted index. And tech, in our view, is still, relatively expensive relative to other parts of the market.
I am curious. I know you're primarily focused on U.S., but I am curious from the perspective of foreign investors, non-U.S. investors who are looking to this market. Are they going to find relative value in that small and mid-cap space in the U.S. relative to developed markets overseas and even emerging markets?
Well, for small and mid caps, I mean, I think the long-term case and long-term attractiveness of the asset class, it still stands, where when you're talking about, long-term return potential for equities, our valuation frameworks are suggesting that large caps could only see low single-digit annualized returns over the next decade, at least in terms of price returns, whereas small caps, given how relatively inexpensive they are, could see much better, closer to 10%, 9-10% annualized normalized returns over the next decade. Valuation tends to be a much better long-term predictor than near-term predictor. But I think short-term, I'd want to see an improvement in the fundamentals for small caps. We've seen much better trends for large caps this earnings season in terms of guidance and everything. Yeah.
All right, Jill, got to leave it there. Jill Carey Hall over at Bank of America Securities.
All right, coming up, you got a once-in-a-lifetime sporting event with Hit Sphere Las Vegas this weekend. We're going to talk to Dana White in the next hour, CEO of UFC, about what makes this weekend's fight so special. This is The Close on Bloomberg.
All right, let's get a view from the sell side. Our top calls. The big movers on the back of analyst recommendations, and we start off today with Shopify. BofA Securities starting coverage of the e-commerce company with a buy rating. The analyst saying Shopify has positioned itself as the leading e-commerce enabler. She calls the company's payments business the biggest driver of growth and says Shopify has also started to increase monetization within subscription solutions by raising those pricing tiers. Investors lifting the stock today by about 1.7%. Next up, U.S. Steel, a lift to overweight from neutral at J.P. Morgan. The price target nudged up to $42, with the analyst citing a favorable risk reward for North American steel companies, especially once the Fed starts cutting rates. He also sees a solid buying opportunity should shares retreat if the Biden administration blocks the company's sale to Nippon Steel. Those shares up 5% on the day. And finally, JetBlue flying out of an underperformed territory after Bank of America raised its recommendation to neutral. The analyst citing improving fundamentals, cheaper fuel prices, and steady travel demand for the upgrade, though he does say high net leverage still a key risk. Investors shrugging it off, bidding the shares up 6% on the day, and those are some of our top calls. We do want to stay in the airline space and take a closer look at shares of Boeing having their best day in about a month. The world's biggest plane makers, or I should say one of them, taking off today after reaching a preliminary deal with its largest labor union to avoid a strike. Workers will vote on the deal later this week, with most analysts optimistic it will be approved. Here in the studio with more insight is Sheila Kahyaoglu, Managing Director and Senior Equity Research Analyst over at Jefferies. She's got a buy recommendation on BA. How you doing, Sheila?
Great, thank you.
Okay, I think we were scheduled, I think we probably would have wanted to talk to you later in the week because a lot of folks thought this was going to go up to the wire. They struck a deal over the weekend. Were you surprised by that?
It was a little surprising because the IAM said a few days ago that they were nowhere close to a deal, and last night at 2:30 a.m. we got a deal announcement or an IAM proposing something that they work with Boeing on. Mm-hmm. But we've seen deals across the other aerospace suppliers in the coverage, airlines, the auto workers. So to answer your question, am I surprised that we're going to get a deal? Most likely no. I'm not surprised because we've gotten deals everywhere else.
And this has to be a bit of a relief for Boeing, too. I mean, because they're obviously dealing, as we know, with a ton of other issues that I'm sure they would rather focus on rather than just dealing with the labor disputes.
Yeah, it's a positive for the new CEO in that we're going to get close to a deal. And the headline number we're seeing is about a 33% increase on average. Mm-hmm. We expected about a 40% wage increase. So net, this is a $900 million headwind if it goes through versus the $1.1 billion we expected. So it's actually a net positive if the union accepts it.
The agreement to build any new airplanes in Puget Sound, did I say that right? Puget?
Yeah.
Puget Sound?
Puget Sound,
Thank you. How much does that raise cash costs for Boeing?
It's honestly something we don't have to worry about very much.
Okay.
The aerospace workforce is in Puget Sound, so it's great to have a new aircraft there. But the issue is the engine manufacturers, they're nowhere close to rates and efficiency on the existing aircraft. But the new aircraft is 2035 plus at this point.
Okay.
So it's a nice to have, but considering how young this workforce is, the labor issues we've seen, it's a great thing to have. But all we're looking for is the wage increases and the upfront increases right now.
Do the workers vote for the deal on Wednesday?
On Thursday, September 12th is the vote, and we need about 51 majority to pass it, so 51%.
And you think it'll happen?
I think 51% is a relatively decent number, and again, this is in line with what we've seen with the airlines and other aerospace suppliers. We haven't seen work stoppages at other airlines or aerospace manufacturers, so it should be approved. We're seeing some pushback, but net, this is still a record increase. I
know Bob Kelly has just kind of been on the job for, I don't know, a month or two or so. Is there a sense here that when we start to talk about what he can do, I guess, not so much just to sort of get things back up into production, but really to kind of reinstill that confidence that was kind of lost under Calhoun in those that sort of last few months of his tenure there. What can he do to sort of make that progress and make it fast?
I think just being, speaking to the workforce. This was the first time a CEO has met with the Boeing workforce since 2008. But Jefferies just hosted our industrials conference, and across the board, we've seen, folks like Textron and Howmet put in wage increases. You don't often hear the management speak to the workforce, so I think that's a positive sign, and just leaning into the employee base.
And so that's a little bit of a shift in what we had seen prior in terms of what management was willing to do in terms of their communications.
Yeah, I think Dave Calhoun had more of a 10,000 foot view, and I don't think that went over the entire workforce really well.
So let's just assume that everything sails through this week. What we saw over the weekends remains. How can Boeing ramp up its production in the back half of the year, and then back half? We're already in the back half now, and then into 2025.
So good news is we'll get another data point tomorrow at 11 a.m. when Boeing releases its August monthly orders and deliveries. We're seeing production in the 23 per month range, which is flat essentially with July levels. Boeing talked about it being flat to slightly up. Obviously, we're not getting that. To hit the numbers, we got to see Boeing put up 36 units in September, which we're not going to get. Let's face it. September seems like a stretch, so that 38 really seems like a stretch. So our delivery forecast of 350 kind of assumes high 30s in the back half. Everybody knows that there's pressure on that. There's so much scrutiny on these Boeing orders and deliveries on a monthly basis, but it's all about, how efficiently and safely can we get 2025 up? And it's all about seeing that just gradual cadence. It doesn't matter. It doesn't have to be 23 to go into 38 tomorrow. It just has to be 23, 25, 27. And just that gradual is enough for investors to see.
Is that part in the stock?
No, not yet, not at $160. But I think there's some hurdles. I think we need to get past Thursday. We need to see September 12th and the IAM accept this deal. We need to see gradual delivery improvement. We need to see defense losses, the Starliner. We didn't talk about that today because they're finally back. Yeah. But we need to see defense losses come in because that, increased it for 25 a little bit. And then, what does Boeing eventually do with its balance sheet and $57 billion of debt? How does it alleviate that?
Yeah, these are really good questions, Sheila. So when you have those answers, let us know. Sheila Kahyaoglu over at Jefferies, thank you very much. Yeah, we didn't even talk about space. We kind of forgot that part.
I forgot
it's
about
like,
that's
happening.
Thing.
We'll talk about that later.
Yeah.
What write-down we're going to see from that.
I know. And the capsule came back without
the
human beings in them. And of course, the SpaceX vehicle will have to get them back. And which, I don't know how you would feel about that as an astronaut. I mean, on one hand, they live their lives to be up in space, but maybe not necessarily for this.
I personally would feel really bad about it, but I'm scared of space, and I don't want to be in an enclosed space. So I'm like the last person you want up there.
An enclosed. I see.
I don't want to be in an enclosed space, and also I'm scared of space.
So you would not be a good astronaut.
I would not be that
person.
And I'm not so great at math, so there is that.
You're checking off a lot of boxes for your career here. All right, coming up here, we're going to keep an eye on what's been going on in the tech sector, and to keep an eye on what's been going on with the S&P. Palantir set to join the benchmark index, and the shares soaring to new heights after the news. We're going to get details on that. It's our stock of the hour, and it's up next. This is The Close on Bloomberg.
After the market close on Friday, S&P Dow Jones Indices announced it's adding a few companies to the S&P. Palantir is one of them. That stock up by about 15%. And since February, it's up a whopping 107%. It is today's stock of the hour. Joining us now for more is Mandeep Singh, Bloomberg Intelligence Senior Technology Analyst. Just walk us through the logistics of how it gets into the S&P and why now and what the weightings are.
Well, I mean, look, they rebalance the index on a periodic basis. And in this case, Palantir made the cut because it's one of the companies that had actually upward revisions to their estimates compared to all the other software companies. We've seen a deceleration. So the fundamentals look good. They are profitable now. So GAAP profitability is one of the criteria. And the fact that, they are exposed to AI and widely held among the retail investors. I think that's what added to the allure of adding to the index. But a lot of people were surprised how they made the cut versus a number of other prospective candidates on the semiconductor side that didn't make it.
That's what I'm curious about. Is this going to be like a SMCI all over again?
Well, I mean, look, with all these companies that are exposed to AI, there is that element that right now they're riding the wave, and at some point there will be a deceleration. We don't know if it's going to be 2 quarters, 5 quarters, who knows? But there are risks. I think with SMCI was more accounting related, at least that's what we know so far. It's very unlikely you will see that with a software company. Software business models are cleaner from that perspective, revenue recognition. But Palantir has a 50% exposure to governments.
Yeah.
So when, government is one of the largest customers, yes, they spend big. But if there is any fiscal restraint, if the administration changes in November and they cut budgets, it's going to have a direct impact. And Palantir just has 600 customers. Compare that to a normal enterprise software company that has 10,000 plus customers.
Wow.
So they are concentrated from that perspective.
Dumb question, but where do they play in the AI stack?
Well, so they focus on visualization. I mean, their products are used across a wide range of industries. The first notable use case is intelligence. I mean, the government uses them for intelligence, visualizing unstructured data, entity extraction. And now they have found use cases in banking for fraud detection, in oil fields, in terms of where to pump oil and that kind of stuff. So basically, they help you visualize data. And that's what makes it kind of the connection with the AI aspect of it, because once you have good data, you can leverage that data for AI. So that's why their growth rates have been much better in the last 12 months compared to a number of other software companies where we have seen pullbacks in terms of the software.
Is there any potential, though, that we could see some of their peers play a little bit of catch-up, particularly in the government space? I know to a certain extent they've kind of owned this niche on the government side here. But, I mean, we've talked with a lot of other companies, with a lot of other analysts who've talked about companies that are really trying to want to get a piece of that action.
Yeah, I mean, look, all your traditional data warehousing companies like Snowflake, I mean, it used to grow 50% plus. Now it's growing 20%, and the valuation has been cut into half. Like, it's trading at 8 times sales, whereas Palantir is 22 times EV to sales. So at some point, you have to ask yourself, will Palantir keep taking share or grow faster than all these companies? Because Salesforce is trying to play in that domain, Snowflake is, and all the other enterprise-focused companies that don't have such a big government presence, they're trying to play in that domain as well, to your point that Palantir doesn't own all the government data software spend. I mean, all these companies play in that domain as well.
All right, Mandeep, thank you so much. Really appreciate it. Mandeep Singh over at Bloomberg Intelligence. And Romain, I should point out, just staying in the tech space, Oracle reports after the closing bell their first quarter fiscal results. It's going to be about their constant currency estimates on a revenue and earnings adjusted basis and that cloud infrastructure growth.
Yeah, it'll be interesting to see. I mean, these are kind of one of the old school players that I think have been, I won't call it catch up, but certainly they want a little bit more of the spotlight shine on them rather than the new kids on the block here. And obviously Palantir, a big one there. And we should point out, of course, Palantir doesn't actually go into the S&P until September 23rd, but the front running.
You got to front run it. Yeah, the announcement in a couple weeks. You got to change it up. Yeah. All right, maybe buy the teal iPhone. All right, coming up, we're going to take you.
We didn't ask Mandeep what iPhone he's buying.
Yeah, are you going to buy one of them?
Yeah.
You are. Which color?
Oh, that I haven't decided, but I'll buy it for the Apple Intelligence. That's what I'm looking for.
He's a big believer. All right, we're going to take you to the bells. We're about 15 minutes away from the close on this Monday. Michael Arone is Portfolio Manager, Chief Investment Strategist at State Street Global Advisors. This is the close on Bloomberg.
Still early September. It's way too early. The market is barely down from the high. We had a pretty nasty correction in August, and usually you get reverberations that are more than this. So I think your guest, Joe Quinlan, was before, buy the dips, but I think it's a little bit premature. There's a lot of things, uncertainty right now. I think we're going to get a rally towards the end of the fourth quarter.
All right, Andrew Slimmon over at Morgan Stanley Investment Management kicking us off to the close. Just about 10 minutes to go. A pretty healthy rally on our hands right now, Alex, as I guess some people took a look at that big drop we had last week and said, look, there are bargains to be found.
Yeah, and let's do it. But, where we're buying, it's cyclicals, right? You got financials, industrials, materials. They're all leading the way higher in the S&P. But the Russell's still up there, up 0.3%, but definitely underperforming the move that we're seeing in tech and then broader S&P.
Yeah, it's a good point here because we talk about the bounce back in big tech. But as Alex pointed out there, when you look at the sectors, at least in the S&P, that are leading the charge on a percentage basis, it is decidedly not tech. And our next guest says that might actually be a good thing. Michael Arone joining us right now, portfolio manager, chief investment strategist at State Street Global Advisors, joining us from the great city of Boston. And Michael, let's talk about the rotation that I guess we had seen earlier this year. People kind of shied away from it, I think, during the summer months. But at least for one day here, with those valuations depressed by the big sell-off last week, people aren't rushing back into big tech. They're rushing back into some of those cyclical and industrial names.
Romaine, I want to dispel a couple myths here for you today. And the first is that this rotation out of tech into cyclicals and value and defensives, it's been going on for 3 months. NVIDIA hasn't hit a high since June. Tech stocks haven't been able to reach new highs since after that kind of August early market volatility. Tech's failed to reach new highs. So I think there's a few things driving this. Certainly interest rates falling, inflation cooling, the fact that the yield curve is not inverted anymore, and the fact that investors have gained confidence that the Fed will in fact cut rates has produced this rotation. And I don't think investors should fight it. I think they should embrace it. And I think we're seeing that today and over the last few months. And the last quick thing I'll say on this to you, Romaine, is that I think there's a myth that the markets can't rally, they can't move higher without tech leadership. And that hasn't been the case either. In the last 3 months, the S&P 500 has actually climbed. So I think those are a few things I would put forward right off the start.
Where's the leadership then within that sort of non-tech group, Michael? Or is it just kind of everything in the basket coming together?
It's been a mix of two things, Romaine. I think it's been a little bit of the cyclical parts of the economy that benefit from lower rates. And so those would include financials and real estate in particular. And those are the two leadership sectors in the last few months. And as Alex just mentioned, sure enough, they're leadership today. They're beating the market today. But also, as the yield curve has steepened, as it's no longer inverted, oftentimes it's not the inversion of the yield curve we should fear, but in fact, it's steepening, it's normalization. So you've also seen a pivot towards some defensive names like staples, like utilities, and healthcare. So I think it's really a combination of those things, some cyclicals, some bond proxies, and some defensive parts of the market that have really started to lead in terms of this change in rotation and this leadership rotation. And I think it'll continue.
So does small caps factor into this? Because if I'm just looking at the last 3 months, small caps are up by only like 3.6% versus, say, S&P Financials, which is up a very healthy 8.5%.
So I think the big thing here, Alex, is that can the economy avoid a recession? If it's able to stick that soft landing, I think small caps pose an interesting opportunity for investors. They're inexpensive. The earnings differential between large cap and small cap is closing. Then you add in some other things that are typically beneficial for small cap: falling rates, cooling inflation, tight credit spreads, a weaker dollar, which has started to unfold. Those four things, they're cheap. Their earnings growth differential is kind of, the gap is narrowing between large cap. And then you add in all the mean reversion stuff. You look at the 3 stocks in the Russell 1000 individually are bigger than all of small cap put together. And they've never made up as small an amount in terms of market capitalization compared to the total market cap of the U.S. as they do right now. So I think as long as we can avoid recession, and that's where the market continues to go back and forth, small cap keeps ebbing and flowing. But I do think that if soft landing outcome is realized, small cap could benefit.
And so what kind of volatility do you expect in that? Because to be fair, we did have a huge run within small caps in the mid-July, right? So you can get some really nice movement here. What's the volatility measure?
So I do think that that's going to be interesting. And I did hear on the replay there with Andrew Slimmon from Morgan Stanley, I believe, when we're talking about it, there's a number of transitions that are now happening. One of them is from a fast-growing economy to a slower-growing economy. Monetary policy is changing from tighter monetary policy to looser monetary policy. Fiscal policy is changing. Of course, we have the election. And so I think there are a number of transitions. And those transitions, Alex, create uncertainty, and that uncertainty creates volatility. So between now and the election, I expect additional bouts of volatility like we had in early August, like we had just last week. But overall, I think the market is in good shape, and I think the economy will avoid recession, at least in the near term. And I think that bodes well for this rotation and for small caps as well.
As we look a little bit deeper, Michael, into 2025, and then folks start to sort of price in expectations for corporate fundamentals, economic conditions as well here, do you think that we will continue to see not just the health, but really the idea of the potential for greater gains? And by that, I mean, even if things stay healthy here, have we pulled forward some of those gains into 2024, or is there still going to be something left for 2025?
So my biggest concern as we head to 2025, Romaine, well, there's probably a couple, but the one that I kind of think is most pressing is the following. So earnings are expected to grow by about 11% year over year for S&P 500 companies this year in 2024. And the earnings figures have been really good, and the earnings results in terms of the quarters and stuff have been very good as well. They're expected to accelerate in 2025 and grow by almost 15%. And that's supposed to take place at a time when our economy is slowing. That just doesn't seem intuitive to me. So my concern is that given that the markets have done so well and valuations are so high, if we fail to meet those expectations of accelerating earnings growth and we disappoint, I do think that could cause some re-rating in the stock market. So I think that is a risk as we go to 2025. You mentioned pulling growth forward. Mm-hmm. Well, my perspective is fiscal spending pulled growth forward, and that's going to abate. Certainly we're in an election season, so neither candidate is promising to reduce fiscal spending. But I think reality is going to hit home in 2025, and that could slow the economy too.
Great stuff, Michael. Got to leave it there. Michael Arone, Portfolio Manager, Chief Investment Strategist over at State Street Global Advisors in Boston. Here in New York, we're moving closer to those bells. Alex, stocks holding to gains about 1% across the board for the major indices.
Yep, taking a look at Oracle, down by about 1.3% as we head into earnings. But I should point out, it's had a pretty good run in the last couple months, up by about 11%. But those earnings we're looking at for the next about 5 minutes.
A lot to break down here on all the market action here on the day. Stick with us. That's coming up right now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick here with Alex Steele, taking you through the Closing Bell. That's the global simulcast. It starts right now. Scarlett Fu in the TV studio, Tim Stenovic in the radio booth. Carol Master still has the day off, and Katie Greifeld filling in her shoes. Welcome to our audiences across all of our Bloomberg platforms, including our partnership with YouTube on a decidedly different day than what we saw, Tim, last week.
Hey, they're out there and they're buying the dip. I mean, we'll see what the economic data say later this week about what the path of inflation has been and what people expect it to do. But for now, quite a different tone than what we saw last week, Katie.
And it's pretty amazing. I remember, the week before last and then Tuesday of last week, we were talking about how bad September is seasonally. And then we experienced last week, and things are going to script, but boy, did it feel painful.
It was painful, but so I guess it's not too surprising that we get a recovery today. What's notable, of course, is that you have the Dow Industrials is kind of the best performer of the bunch, certainly out of the S&P 500, the NASDAQ, and the Russell 2000.
Right, that real economy, right? The cyclical is performing really well. That leads me to Wednesday, guys, because Stuart Kaiser over at Citi says they're looking for about 110 basis point move per options on the S&P. That's post-debate and CPI day. Yeah, and I think this is, we kind of heard this from the chief technician over at Piper Sandler talking about kind of how this market's kind of in this weird netherworld right now, sort of, between the Fed, between obviously the debate and the election, and of course all the fundamentals from corporate earnings that fall in between here. But for right now, I guess that is a good thing here for markets that are sitting on some pretty healthy gains coming off what was one of the worst weeks that they've seen in more than a year. The Dow Jones Industrial Average higher by almost 500 points here on the day, up about 1.2%. And look at that. Flava Flav ringing the closing bell there at the NYSE alongside, this is the women's water polo team. So
does he have a clock around his neck?
He's Flavor Flav. The S&P 500 up 60 points here on the day, or about 1.2%. The NASDAQ higher by almost 200 points, or about 1.6%. Your relative laggard on the day is the Russell 2000, though that's also closing in the green, up by 0.3%.
I did hear that he was at the U.S. Open taking pictures of fans.
I saw it.
Was that the Sabalenka final, I believe?
Yes, he was there at that final.
Yeah, okay. We'll talk about that in just a minute. Hey, taking a deeper look at the S&P 500.
He's having quite the summer, though, right? Like he was at the Olympics. He's like sponsoring all these athletes, and now here he is bringing the closing. And he seems to really be enjoying it too.
It's not a bad place to be right now. I like that. The S&P 500, the vast majority of stocks moved higher. 419 in the green today, 83 in the red today.
And a lot of green when you look at the IMAP, which breaks down the S&P 500 into 11 industry groups. In fact, all 11 groups are higher. Consumer discretionary, industrials, and tech lead the way. And if you were to break down the S&P into 24 groups, the only group that is in the red is media and entertainment. That group down by 0.3%, largely on the weakness of Alphabet.
All right, well, I don't got weakness for you. I got strength for you with the gainers today. I want to start with shares of Boeing higher by 3.4%. We can go ahead and round that up. Shares rallied on optimism that a labor deal with its largest union will help the U.S. aircraft manufacturer avoid a potentially crippling strike at its Seattle area factories. The accord with union negotiators promises to be a significant victory for Kelly Ortberg, the company's new CEO, but it's too soon to know if workers are going to go along for it or buck their leadership with anti-management sentiment still running high on the factory floor. The details that were hammered out over the weekend include a 25% wage increase over 4 years and a commitment to build Boeing's next plane in the Seattle area, the two sides said in separate statements. Also, taking a look at shares of Palantir, they posted their best one-day gain since February, finishing the day higher by 14%. All because of news that it's one of three companies that will join the S&P 500 as part of the latest quarterly weighting change prior to the open of trading coming on September 23rd. Palantir shares jumping to their highest intraday since February 2021. Wedbush analyst Dan Ives called the addition a, quote, validation moment for the stock. The other two companies that were announced, Dell Technologies and Erie Indemnity, those shares also higher today. And some weed stocks moving higher on the day today thanks to something that former President Trump posted to his social media. Tilray Brands being one of those, higher by close to 5%. Donald Trump posted on social media his support behind several cannabis issues, including drug rescheduling, Florida legalization, and safe banking. Katie?
All right, let's take a look at some decliners right now. I wanted to start with Merck. Of course, this was really interesting news coming early this morning that Summit Therapeutics, in partnership with another company, released or presented the latest data of its lung cancer drug, which actually showed statistically significant improvement. There we go. And that, of course, has concerns around Merck's Keytruda, of course, which is very popular. So you could see those jitters in the stock as well. Also wanted to take a look at Alphabet. Google, of course, the ad empire under fire as that U.S. antitrust trial begins. You remember, of course, 1 month ago, it lost that landmark ruling that it illegally dominates online search. So those antitrust concerns still plaguing Alphabet. And then let's end with Nike. No real news here, but the stock did have another down day. And it's just been a terrible year for Nike, of course, down 26%, and of course, down a little bit more today.
All right, we do have some earnings. We are awaiting Oracle earnings, but Rubrik, data cloud software company, out with its results here. Third quarter revenue coming in at roughly about $216 million. The company providing a guidance here, and I'm just going to get right to it here because this seems to be the result of the weakness that we're seeing in the shares. The company providing guidance of 216 to 218 million in third quarter revenue. The street was looking for 215 here. So that's slightly above. The adjusted loss for the quarter at about 39 to 41 cents is the guidance. The street was looking for 43 cents and full year basis. You're looking at revenue guidance of 830 to 838 million. The street looking for 824.
All right, I'm taking a look at the bond market here, guys, just for your wrap up. Not a lot to see here. A little bit of selling on the front end, but that's after some massive buying that we saw all throughout last week. That 210 spread also now disinverted by about 3 basis points, not the 6 that we saw on Friday, but nevertheless the 3. So sort of steady as she goes as we head into CPI, guys.
All right, well, we are awaiting more companies than just Rubrik reporting earnings. We're still expecting Oracle to post its results. First fiscal quarter results are going to have investors hopeful for continued acceleration in their cloud infrastructure business.
Yeah, let's take a look. This is the fiscal first quarter. Adjusted revenue, $13.3 billion, slightly higher than the expected $13.25 billion. Adjusted operating margin, 43%, also better than what was anticipated. Adjusted EPS of $1.39, beating the consensus of $1.33. The point, the part of the business everyone's fixated on is the cloud infrastructure revenue. That was $2.2 billion, in line with what analysts had anticipated, but this was seen growing 46%. So it is that scale of that increase that has impressed a lot of investors, especially because it's been seen as kind of an also-ran when it comes to the cloud business, but it's slowly been building up a lot of quite a bit of a reputation as a go-to and a very reliable cloud source of cloud infrastructure.
Well, how's this for scale of cloud infrastructure? Oracle Chair and CTO Larry Ellison says that the company has 162 cloud data centers in operation and under construction around the world. The largest is 800 megawatts. It's going to contain acres of NVIDIA GPU clusters for training large-scale AI models. And in the first quarter of the year, 42 additional cloud GPU contracts were signed for a total of $3 billion.
You take a look at how shares are reacting right now. It seems like investors after hour are deciding that all of this is good news. Oracle shares currently jumping quite significantly, up 4%. Initially spiked lower after the release, Romaine, but now definitely higher. Of course, adding to what's already been a very good year for Oracle.
Yeah, now one thing I like about the release is they always sort of put in some of the customers that either were onboarded or increased purchases in the quarter. Of course, you mentioned we have the Palantir on there as well, but a lot of healthcare companies too. And it gets to this idea here of who really needs this type of data power, who needs to really sort of take advantage of some of these AI capabilities. And at least if you use Oracle as a proxy for that, you do see a lot of healthcare names in that space.
Yep, and also AWS. They say in the press release that biggest news of all was signing a multi-cloud agreement with AWS customers getting that access to the Oracle database when they go live in December. Also some more color here. 42 added cloud GPU contracts signed for $3 billion in the first quarter. That adjusted revenue overall coming in $13.31 billion. I mean, this is it, guys, right? Like you have some AI offerings and then you make money off of it. And then you have the numbers that come out and then your stock goes up.
Nothing in the press release about Paramount.
You make it sound so simple, Alex.
Nothing in here about Paramount, guys.
About
Larry.
You had to go there, didn't you?
Nothing in here about Paramount.
That support is implied. It's not explicit.
Okay.
It's just kind of in the background.
That story.
That's a side project. It's his fun thing that he does on the side, right?
The story continues to go. That is going to do it for our cross-platform coverage of the market close on Bloomberg TV, radio, YouTube, and Bloomberg Originals. We're all going to be back tomorrow, same time, same place. Katie and I are going back to radio and YouTube. Alex is heading out. Scarlett and Romaine will continue on TV.
And we continue our coverage right here on Bloomberg Television. A closer look at the tech trade with those earnings out from Oracle. Jeremy Bryan, portfolio manager over at Gradient. He'll be joining the program in just a second. This is The Close on Bloomberg.
Welcome back to The Close. I'm Scarlett Fu.
And I'm Romaine Bostic. Stocks coming off their worst week in about a year and a half, really trying to recoup some of that ground here on this Monday afternoon. And S&P 500 reclaiming about 1% of that, 54.71 here. But it's really more about the sentiment shift. The idea here that you're seeing a little bit of a broadening here in the dip buying, not just big tech. Yes, the stocks did get a boost, up about 2%. So too did the Magnificent Seven. But biotechs were higher, financials were higher, industrials were higher as well, leading the charge here on this Monday afternoon.
Yeah, it felt like a lot of stocks were higher, including those that were down earlier, which we'll get to. I want to start with Boeing, which is one of the best performers in the Dow Industrials. It rallied the most in about 3 weeks on optimism that a labor deal struck with its largest union will help the plane maker avoid a costly strike in its Seattle factories later on. Members actually vote on the deal on Thursday. The stock up about 3.33%, but it is still down around 37% so far this year. I mentioned Apple. At one point, it was lower for a fifth time in 6 days, but it did manage to close in the green, just barely, after unveiling its iPhone 16, which will be AI-enabled once key features of the software get rolled out next year. So for anyone buying the iPhone 16, that's not going to happen right away. Which brings us to our top story this hour. Maybe AI is no longer the difference maker it once was. You look at Apple's official pitch on its upcoming AI features, didn't do much for its stock price today, and analysts warned that AI may not even be the key reason for consumers seeking to upgrade their phones. phones in the coming months. Now, for startups with a lot less cash to spare, the math to build up their own AI systems has gotten a lot harder. And for companies overall, it turns out artificial intelligence is a priority for digital investments, but it trails cybersecurity and cloud computing. So while it is a priority, it's not the first priority. And we'll get into all of that later on in the program, Romain.
All of that folds in, of course, to the broader tech story here and is a big sort of driver for what you're seeing in names like Oracle. Those shares higher here in after hours trading. The software company reporting results that beat estimates across the board. Guidance that also looked good as well. Arurag Rana over at Bloomberg Intelligence joining us now to discuss a little bit more. And let's start off with that cloud infrastructure revenue, which seems to be what everybody was focused on, 47% growth.
Yeah, and to be very honest, we thought it would improve a little bit, but we'll wait for comments on the call. But it's possible that because of supply constraints with the lack of GPUs, they may not have been able to realize something. But the real kicker at this point is their partnership with AWS, which is their biggest rival in cloud infrastructure. So when these guys work together, I think it's going to help out their database business.
So what does that say, Arurag, about these different cloud providers and where Oracle fits into the Microsofts, the Amazon Web Services, and the Googles of the world?
Yeah, I would say that Oracle is probably a late, I could say, bloomer or agreeable that they can work with other cloud providers. We have seen at the end of the day, if the client wants to work with cloud providers, the technology company will have to agree to that. And so far, they have been a little bit hesitant in this thing. But over the last 12 months, we have seen them sign deals with Microsoft, Google, and then now AWS. So that's a good thing for Oracle's database business, which is still largely on-premise at this point.
And that's a good point, too, Arurag. I mean, talk a little bit about that split between the on-premises type of model that Oracle has, at least for right now, and the idea that you have other companies that are sort of looking at more of an off-premises thing. Is this an advantage for Oracle, or are they going to have to shift a little bit more, or at least diversify a little bit more?
See, they will have to be a little bit flexible in terms of losing out some revenue, but I think they're going to gain a lot more credibility in the market, and their database is going to be a lot more stickier if they can allow that to be hosted on all these clouds. Now, you can still do that, but you have to pay a little bit extra. So they have been very adamant that, host these things on my cloud only, and you're going to get some more benefits. But I think they are changing their tune a little bit. Not only that, they're actually getting a lot of the AI workloads from the likes of Microsoft because they need to fulfill the capacity that they are getting from running AI or open AI workloads.
Right. So they're in a good position here. Arurag, when we talk about Oracle, it has a history as a serial acquirer, right? It buys a lot of other companies and that it keeps its growth rate up. Can it go back to, or will it go back to that playbook, or can it continue to build out this cloud infrastructure business organically?
I think they really don't need to do that at this point in the infrastructure side because they are seeing a massive demand coming in. Because at the end of the day, how many cloud providers are there? There are a handful, only the 3 big ones, and then now it's Oracle. So they have the workloads coming in. They just need to figure out how to expand their data center footprint in order to fulfill that demand.
All right, great stuff. Arurag Rana, thank you so much for joining us. And you could see Oracle shares continuing to rally in the after-hours session. Firmly turning higher by about 5%. Now, let's get a broader check here on the tech sector overall and bring in Jeremy Bryan. He is portfolio manager at Gradient Investments. Jeremy, are we starting to see, or did earnings this quarter make clear that there are winners and losers when it comes to AI, and the winners all happen to be in the cloud space, especially when expectations are low?
Yeah, I mean, at some point, the early winners were the horsepower winners, right? How do I get the capacity to do what I need to do? At some point, we're going to have a shift in that, and it's not the horsepower that you provide me, but the services to use this stuff going forward. And that's where I think this next gen could actually show some benefit. Now, we didn't get a lot from Apple today, to be completely honest with you, on the AI front. But that's kind of where the next evolution comes from is, hey, we've built all this stuff up. We've got all this horsepower and all this capacity. What is actually the value add that we're going to use? And from our side especially, what I think people paid attention to at the early set was the consumer-based AI. We're focused a lot more on the enterprise-based AI. I think that's where your opportunities are. How can you make my business more efficient and process better and faster so that I can get to my customers better? I think that that's really where a big opportunity lies, and a company like Oracle sits at that space.
Okay, so aside from a name like Oracle, where do you want to invest? What companies will get you to that exposure? It's no no longer the hardware companies because that was the first wave.
Yeah, I still, I'm one of the lone believers here that I think Alphabet is still one of the people in the catbird seat for developing this. And I always go back to who has the best data. And they still, at the end of the day, have the best data across the board. Now, again, right, what's going on right now with regard to antitrust and all that, it's certainly an unknown, and we don't know where that ends up. So I understand the argument against it. But from our perspective about how you could add value, I think they're just right at the centerpiece of a lot of things to do, whether that's video based, whether that's business to business, like I talked about before, or the business to consumer, just knowing consumers better than anyone else. I think Alphabet is still in a really good spot here. All right.
Jeremy, we got to talk about the consumer-facing side of this. Of course, Apple had its big, splashy product event. There are a lot of people that saying, ho-hum, the iPhone's a little bit thinner and you get a better camera, et cetera, et cetera. But, of course, what people really want to see is how they integrate these AI features and those software updates that they're saying could start to come in October.
Yeah, I think specs are table stakes now, right? You just don't get a lot of value. If I'm buying the latest phone, I better get the best chip and I better get the best camera and all that stuff right now, to where it just doesn't move the needle as much as it used to. So now it's, what can my phone do for me if I buy a new one that this one currently can't do? And I think AI is their best capability in that space, especially for the phone. But to be honest with you, that's where we were a little meh. I mean, a real official term there is meh, is there wasn't a lot there. I mean, I think that's more of a 2025 thing for Apple going forward, is bringing out services, improving and enhancing what Siri can do for us. Those kinds of things that'll add incremental enhancements that's going to say, okay, I've got the best phone, but I need another one. I need a new one because I can't do the things that I can do on my old phone. So that's where I think that quote unquote super cycle, whether it's a super cycle or just an enhancement cycle, I think that's where it comes into play. I'm not sure they really relayed that case on this cycle for this phone.
Yeah, and with the caveat that at some point they'll probably get there, but it does raise the question. Look, I understand they've kind of committed themselves to this sort of annual process every September or so, and it just kind of makes you wonder why they just didn't wait a little bit longer. I mean, we had a couple of folks on Bloomberg earlier today were kind of like, this is the first time they've really kind of reduced a quote kind of beta version of an iPhone, and like, why not? If you think you're going to have these software features ready by October or November or whenever they said, why couldn't you have waited a couple of more months?
Certainly could have. Right. I think, the expectation is, hey, we're going to do this and we're going to be in beta and we're going to do that. Could they have waited? Absolutely. Where they are innovating, and I do like to hear from them, don't get me wrong here, is where they are innovating, which is interesting to us, is a little different of an animal. And it's not what a lot of people are talking about. It's the healthcare space and what they're doing with regard to AirPods and the ear-centric ear protection and enhancements there, the Apple Watch with the sleep apnea stuff. We think healthcare from a device perspective, from something that you wear, healthcare components are going to be where people are going to look for enhancements there. And that's where I think you could add a lot of value. And I think that's a space that was interesting in their release.
Well, that was the interesting thing. Probably the most interesting thing out of the presentation were the features on the new AirPods, that in theory would primarily be targeted towards people with disabilities, but even just regular able-bodied people, I think, would find them interesting. And I just wonder why they don't, I guess, promote that a little bit more, because I don't know, maybe I've been in the dark, but I feel like I don't hear about this as much.
Well, they got to go, so let's say they didn't answer any questions about AI. We'd be sitting here and be like, what are they hiding and all that. So you kind of got to lead with that, right? But these kinds of things can kind of incrementally come into play and say, hey, while we're doing this and while you're interested in this, we also have a lot of this cool stuff over here. But you're right. It's not a 100% penetration rate story. It's an incremental ad story where this segment of the population could benefit from that. This segment could benefit from that. But adding it all together, and just more and more people are going to want to use devices for the things they want to monitor or check for their own health systems. And we think that that's just green space for companies like Apple and other companies to take advantage of.
All right. Jeremy Bryan, portfolio manager at Gradient Investments. Great stuff. Thank you so much. Incremental ad stories seems to be kind of the theme overall for what Apple's been doing recently with its iPhones.
All right, we're going to get back talking about tech here. Some breaking news, though, in the world of finance. Goldman Sachs CEO David Solomon speaking at a conference sponsored by Barclays, providing some guidance on trading revenue on a year-over-year basis, saying that will be down by about 10%. Solomon also saying that they expect about a $400 million pre-tax impact from its consumer unit. minute. Of course, this is a Barclays conference where, of course, CEO David Solomon is speaking, laying out some of his financial forecasts. We'll keep an eye on that and bring you any additional headlines as soon as we get them.
And it looks like the stock is falling in after hours trade, at least from the close this afternoon. All right, coming up, we've got the top three, where we focus in on the top three movers and shakers at the center of the day's big stories. This is The Close. It's time now for the top three, where we name drop the people driving some of the day's most talked about stories. And first up is Kate Middleton. The Princess of Wales is now cancer-free. She said she has completed her chemotherapy treatment and is now set to resume a light schedule of royal duties.
Yeah, well, first of all, congratulations to her, and just hopefully the media will give her space here to heal as she goes through the next phase of this process here. But definitely good news there for Princess Kate. I'm keeping an eye on Bryan Nickel. Remember, he was, of course, the CEO over at Chipotle. Now going to be the CEO over at Starbucks, finally starting here. And I don't know, does he have to go through like the onboarding process where they make him do training and, give him his ID
even be there, though. That's
or anything
the thing.
else? Yeah, I don't know how that works when you're working remotely. But of course, he's got a lot to do. And investors, of course, have high expectations for a CEO who's being compensated very well. And as you alluded to, of course, doesn't even necessarily have to go into the Seattle office.
Into the Seattle office.
Yes.
I mean, one of his biggest challenges will be dealing with China. At Chipotle, he didn't have to deal with international markets the way he will with Starbucks and facing competition on the mainland. All right, third on the docket for us today is Kendrick Lamar. The rapper will be headlining this year's Super Bowl halftime show. So I guess this means officially that Drake has lost in every way?
Yeah, well, he lost a long time ago. I mean, well, I was saying earlier how Flavor Flav was Summer Summer. I mean, how about Kendrick Lamar? I mean, you go from kind of having an album that did okay, and then all of a sudden you get into this beef, and, he has the hottest song of the summer, and now he's going to be performing at the Super Bowl officially. And I say officially because everyone said this is the second time, but remember when he performed at the Super Bowl last time? He wasn't actually at the Super Bowl. He was like at a different site.
Yeah.
So I feel like this is going to be much more different because you're in the stadium and
no, he's headlining it. It is about him.
It's about him, around him.
Right?
So this will be great. I'm excited to see. I mean, he's a very creative guy. I don't know if you've ever seen any of his concerts, but he puts his all into it. But he's going to have to do a lot because he's got to kind of bring the whole New Orleans vibe into it. And
it's going to be a big show.
And everything in there. So that, and I'm sure, I don't know, maybe he'll bring up, I forgot, one of our producers reminded us that he had done, I know you're a Taylor Swift fan, he had done a duet with Taylor Swift.
Oh, I didn't realize that.
Some time ago.
Okay,
so maybe he could bring her out.
If the Kansas City Chiefs become a three-peat contender for the Super Bowl, maybe that. That might very well be in the cards. What about the
Jets? How are they doing this year?
Well, they're going to play tonight, so we'll see.
Is that Achilles heel going to hold up?
We'll see.
All right, when we return, we're going to actually take a look back at a big day for the S&P E-mini futures, and a question before we go to break. Which event spurred the biggest volume day for S&P E-mini futures ever?
Oh, good question.
I know, it's a hard one. Here. All right, I'm going to give Scarlett some time to ponder that. We're going to take a commercial break, and we'll get you the answer when we come back. This is The Close on Bloomberg. All right, let's take a quick look back in history. On this day, September 9th, 1997, the retail revolution in public markets took one of its most significant turns when the Chicago Mercantile Exchange introduced a new futures contract based on the Standard & Poor's 500. Now, to be sure, such a futures contract already existed, but at a multiple of 500 times the cash-based S&P, speculating on the price direction of the S&P meant you would have to commit a minimum notional value of 500 grand with a margin requirement of roughly 25 grand for one single contract. That was fine for deep-pocketed institutions, but for individual investors, that was a price far out of reach. The CME, it figured it can generate business by offering a bite-sized version of that contract. Enter the E-mini S&P futures. Initially, they were about 1/10 the size of the benchmark S&P futures contract. And even more importantly, instead of relying on physical pit traders to fill those mini orders, the buying and selling would be done electronically over the internet, hence the E in E-minis. Roughly 6,580 contracts swapped hands on day one by the close, but that number would slowly grow over time and in a big way. And that brings us to our question of the day. What was the biggest volume day for the S&P E-mini futures? while there have been big spikes around the pandemic in 2020 and the credit crisis in 2008, the most active day was on August 9th, 2011, amid a rebound rally in stocks coming off a 7% plunge that occurred the day earlier in the aftermath of a downgrade of the U.S. government's AAA credit rating. Today, about 1.5 million contracts swap hands on average each day, or about $80 billion worth. That eclipses all other futures contracts, all other ETFs out there. Nothing comes close. The contract has become so dominant that the old, larger S&P futures contract was eventually abandoned altogether in 2021. And these bite-sized contracts, meant for retail traders, are now the de facto standard across the industry, large and small. Its liquidity unparalleled.
I guess the 2011 date in August makes sense, given that that was such a complete moment from out of nowhere that a ratings company would downgrade the U.S.'s AAA credit rating. No one had anticipated or even thought that was going to be in the realm of possibility. And then now it's becoming a thing that tends to happen quite a bit. All right, let's switch gears here and talk about AI, investing in AI specifically, because it's proving to be more and more expensive as time moves on. Big tech companies and startups like Meta, Alphabet, OpenAI, and Anthropic have raised billions of dollars to maintain their dominance in this space. But for those without the deep pockets, keeping up in the fast-moving industry is proving to be more of a struggle. Joining us now for more on this is Rachel Metz, Bloomberg News AI reporter. And Rachel, this comes down to the fact that startups that are looking to do more in AI, train their large language models, used to be able to raise tens of millions of dollars, hundreds of millions of dollars, and that would be enough. But now they're finding it's nowhere near enough.
Yeah, over time, building more and more powerful models using the kind of technology that's currently most popular is really difficult and really expensive. And this is expected, at least given like the prevailing ideas, to just keep getting more and more expensive in general right now. So we're seeing some companies say, you know what, we can't do this, or you know what, let's not do this, let's try something else.
Do they have that option to not do anything? I mean, I know in the short term, okay, that makes sense, maybe you sit it out, but if this does end up being the revolution that everyone seems to think it is, I mean, this sounds to me like you're saying that a lot of these companies are just going to get left behind.
I mean, I think the fact of the matter is that making a large language model is quite expensive. And there's also a question of, well, how many does the industry really need? I think what you're starting to see is some companies realize, hey, maybe we need to do something different. Aleph Alpha is a company that we've been keeping an eye on, and they're a German company. They were building a large language model, and then they decided to switch directions. We've also seen several companies such as Character AI, Adept, Inflection, that have moved in different directions. They've been acqui-hired.
So what does this mean for the big tech companies that do have the financial resources at their disposal to invest in building out their AI capabilities? What limits can they put on it, or are investors putting them on?
I think that sort of remains to be seen. I think we're going to see over the next few years if companies keep building in the way that they are now with the kind of AI that is popular now, or if different types of models emerge. We're also seeing popularity with smaller models that can be trained more cheaply. Then they're getting better and better. So it's kind of, it's still a little bit tricky to figure out what's going to happen, actually.
Yeah, but it's a fascinating conversation. And your newsletter was one of the first things I read this morning. Rachel Metz with Bloomberg here, a closer look here at some of the challenges of adapting to this new world of AI, a very costly world of AI. And while investing in that space is a top priority for those in the C-suite, as we just learned, it's not the top priority to keep business running as smoothly as possible. That's according to a new survey on digital disruption that's just out this week. And one of the men behind that is joining us right now. Simon Freakley is the chairman and CEO of AlixPartners. And Simon, it's always great to talk to you because you kind of understand these trends better than most people because you talk to a lot of these folks here. And we focus so much on just these small cohort of companies that we know are spending on AI and have to spend on AI. What about the ones outside that realm?
Well, one thing we know, Romain, is that AI is going to change every job in every industry in every geography. So the change is going to be profound. The speed at which that happens is another question. Having said that, for most businesses that will need to access large language models, there are already many hundreds of them to access. They're the main ones we all know about, but there are so many large language models now and more to come. The winners are not going to be the people with the best large language models. The winners are going to be the people who have the best data and know how to use it. So for chief executives of corporations, our clients I speak to every day, the 3,000 CEOs we survey every year on these topics, what they're now starting to understand is they'll have a range of large language models to choose from, but the key is to capture and understand their data.
Do they have the capability to do that now, or is this something they kind of have to build out over the next, months and years?
Well, there's a lot of exploration going on. And I sit in our clients' board meetings, probably 50% of the board meeting is talking about AI and generative AI. When you look at their budget line item, less than 10% of their IT spend is on AI and generative AI. So at the moment, it occupies much more of their mind space than it does their budget space. But I think the budget will keep up. And interestingly, our most recent survey shows the biggest spend is not on AI in corporates. The biggest spend is on cybersecurity. It's on migration to the cloud. It's on other aspects of the IT infrastructure they have to support the scaling and growth of their businesses. So I think there's a time lag happening on investment for AI.
Okay, yeah, that makes sense that you want to make sure that your systems are safe first before you then plow more money into your systems overall. You mentioned the winners are those who get the data and know how to use it properly.
Yes.
Are these new skills, or is this something that requires hiring and training people?
Well, looking, Scarlett, at different industries are at different levels of maturity. So financial services and healthcare, for instance, are more advanced than most. Automotive is more advanced than most. They've captured the data, they've interrogated the data, they've understood the data, which means if you're an auto producer, you can do hyper-personalization of vehicles, which is driving sales. If you're a financial services company, you can do hyper-personalization of financial products. So there's very uneven progress across industries, but the capturing of the data, number one, if you're in the retail sector, for instance, or consumer products, but then the aggregation and interrogation of the data is what people are marking themselves out as being. But one thing I would say, Scarlett, is that what we're seeing is when we look at top quartile performers in any of these industries, the top quartile performers are doing a number of things similarly, and one of those things is that their head of digital strategy is joined at the hip with the head of business strategy. So the digital teams are solving business problems, they're not just solving technical problems. And our analysis shows that 80% of all investment in AI and generative AI fails, and it's largely because they're not focused on the core of the business issue, they're trying to solve a technical issue.
I see. They're almost working on different problems entirely, as opposed to thinking of the main crux of the issue here.
Exactly.
In terms of spending, and you talk about how cybersecurity, cloud infrastructure is a bigger priority, but we hear about how cybersecurity has elements of AI that they want to incorporate as well. So there is a pathway to incorporate more AI into cybersecurity, which is a lot of these companies' immediate priority.
Exactly. And so what happens is the developments in AI and generative AI are making bad actors, sometimes state bad actors, able to do things that formerly they weren't able to do. So AI and Gen AI has accelerated the threat of cyber security, data loss. And so, yes, it does feature. But at the moment, the majority of the budgets are going to those things rather than AI. And what's so interesting as well, as I move around the world talking to our clients, is that people have pretty much understood how to use AI and generative AI for efficiency. You know, all the stories we hear about the efficiency of call centers and internal Q&A resources. People haven't yet really understood how to use these tools to drive revenue growth. Now, given that every investor worships at the altar of growth and every CEO serves at the altar of growth, everybody's trying to work out how to use these tools to drive revenue growth in their enterprises.
Do they have anxiety, though? Because even if you get to the stage where you sort of recognize, okay, maybe we should kind of slow walk this. I mean, as you know, there's a lot of pressure coming from investors and obviously the whole hype in the media. So it's like, even if you're a CEO who says, oh, I'm going to slow walk this, you're going to have to get on a conference. If you're a public company, you're going to have to get on a conference call in 3 months and take a bunch of questions from analysts wondering why you haven't articulated an AI strategy.
You're so right, Romain, and this is why, as I mentioned, that 50% of strategy sessions and board meetings are talking about just these issues, but the spend hasn't caught up yet. People are doing trial and error experiments to see what works. They're not making themselves a hostage of any one large language model, which is right, because I think every major corporation will end up having a number of ones they license and then probably one or two of their own to deal with very specialist things. And CEOs and business leaders are having to articulate their strategy, but take baby steps as they work out the right direction to go.
To what extent do CEOs need to rethink or maybe recalibrate their strategy when it comes to spending on AI and AI-related things, given the slowdown in the economy and given the change in the overall economic cycle?
Well, interestingly enough, the inverse might be true, which is given the headwinds in the economy, given how difficult it is to reach for revenue growth, what investments should be made deliberately and boldly now to try and outrun those forces? So people are saying, look, let's take pricing, for instance. Can we use generative AI to come up with really imaginative, dynamic pricing such that we can then add revenues to top line through better pricing? You can have the same discussion about fulfillment in retail. In grocery chains, for instance, if more and more people are ordering groceries online, should the stores be more set out for the pickers than the shoppers? And AI is really helping people do these little adjustments to their revenue models to try and add incrementally to their revenue top line. So people are having to be bold and having to try things out, but never be a hostage to a strategy they can't pivot away from quickly.
Interesting. Simon Freakley, thank you so much for joining us. Simon is CEO of AlixPartners. And I guess that idea that companies will be more engaged and more committed to dynamic pricing means inflation just becomes something where it's not a long-term trend. It's something that changes month to month.
Oh, my gosh.
Can you imagine?
Jay Powell needs to cover his ears there. But I thought one thing I thought was great about what he said, and it was also in the survey, was really just this idea that a lot of these CEOs are kind of comfortable. They feel like they have a comfortable knowledge of the general idea of what they need, but not necessarily with regards to how to sort of create value from that.
Right.
And I feel like we've kind of seen that reflected on conference calls and some of the earnings where everyone's expecting to see some big boost in revenue and profitability, and you're like, where is it? And that's the problem.
Right. Everyone's still in the mindset of, I have to mention it in the press release. I also have to mention it in the earnings call, but I'm not going to promise too much because we don't actually know how we're going to deliver on this. All right, let's take a look at how markets closed on the day, because you did have a recovery in the markets that was pretty dramatic, and it extended throughout the trading session, right? With the S&P 500 closing up 1.2%. Apple actually finished higher, which is notable given that it was weaker for most of the day on the big day of its product launch.
And by higher, what was that, like a 1/10%?
Just barely.
I guess it's better. Why? You can get your new teal phone.
No.
Alex loves the teal.
No, no, I don't need this.
All right. Well, there you're looking at a market. It'll be interesting to see what happens later this week with the CPI report, heading into a Fed meeting, and of course, a lot of other concerns here, a presidential debate, a lot of other things that could move this market.
This is The Close on Bloomberg.
All right, welcome back to The Close. Live from New York, we go out to Las Vegas because where since opening just about a year ago, the Sphere in Las Vegas has dazzled tourists with its crafty and unique visuals. And this weekend, it's going to host one of the biggest sporting events of the year. Ultimate Fighting Championship will use Sphere's technology to host its UFC 306 event. Resale tickets right now selling from $700 to $900, and if you've got $8,500 lying around, you can still snag one of those VIP packages. Joining us right now to talk a little bit more about this is the president, co-owner, and CEO of the UFC, Dana White. Dana, thanks for zooming in for us here on the big program here. This is a huge event. I do want to start off with the venue itself because it is unique, and so far it's primarily been used for concerts and other things. Talk about what sort of changes, if anything, that you had to consider in moving a sporting event to a venue like this.
Yeah, well, first of all, it's never been done before. A sporting event has never been held there, and a live event that's beaming out to the rest of the world has never been done. So there were a lot of challenges in pulling this off. But, I like to be first. I went to see U2 there. I love the technology, and I wanted to take this challenge on.
What type of the Sphere technology, is that going to be incorporated into the actual matches and other events themselves? Will it be like while the fights are taking place, or is it going to be more used kind of in between the different bouts?
Yeah, so one of the things that I realized when I went to see U2 at the Sphere was that the Sphere was the star of the show, not U2. I was in Dolan's box, so I was sort of sitting back listening to like U2's greatest hits while they're playing, and I was focused on the screen and what was going on. And then every once in a while I would peek over and look down at U2. So one of the biggest, there were many challenges production-wise for this event, but one of the biggest challenges was how do you make sure that they're looking at, we're going to do these films that will come in chapters. So there will be a chapter of the film before a fight, then the fight will happen. So you will be focused on the Sphere,
then the focus will, the attention will be to the fighters during the fights. Now, the media plane in the back will stay alive during the fight, and it will clouds will be moving, birds will be flying, fires will be, whatever is on there, and it will slowly evolve during the fight.
I see.
And lead us to the next chapter of the movie.
Okay, so I understand the UFC has spent $16 million on UFC 306. Has this number risen? And I ask because I wonder if this is the most expensive UFC event ever.
The budget for a big UFC event is usually between $2 and $2.5 million. Our budget was $8 million for this. We're $20 million in.
Wow. $20 million in. Are tickets selling at the rate you expect, Dana?
Yeah. Tickets are going like they always do. We will sell out this week or the night of the event. It's the biggest gate in UFC history, 22 or 23 million it'll end up at. And the biggest fight we've ever done for pre-buys. People buying the pay-per-view a week before the week of the pay-per-view. It's the most pre-buys we've ever had in the history of the company.
I believe you also said that the event at the Sphere will be a one and done. And I wonder why that is. Is this because of the deal that you have with MGM to be an anchor tenant?
Yeah. So we have a deal with MGM. We had a problem. The resolution to this problem was I wanted the Sphere for Mexican Independence Day. They gave it to me. This will be a one and done.
All right, well, let's talk a little bit. Just real quickly, Dana, I do want to talk about the Mexican Independence Day side of this. But on the cost structure, because I didn't realize how much money that you had to put in this relative to your past bouts here. You do have sponsorship for this in a way that you didn't have for previous events. Just kind of explain that.
Correct. So the way that I do things normally is if I have a vision for something, I figure out, first of all, what do we have to do to execute this? Second of all, I bring on our finance team to walk me through what they think the number is going to be to pull this off. So then I do it, I pull the trigger, then I go out and figure out how to pay for it.
Okay, nice job there. I'm sure that's not stressful. Dana, talk about the Mexican Independence Day side of this. I mean, looking at the idea here that you're kind of leaning into, at least for what a huge part of our population is a huge day, and you're really embracing that in a way. Is this a strategy to sort of gain, new followers, new customers into the UFC ecosystem?
Well, we have a very, very large Hispanic following already. And I just opened a performance institute down in Mexico. So this is sort of my love letter to Mexico. This entire Mexican Independence Day fight is going to be about their history, their culture, their traditions, their contributions to combat sports. Some of the baddest dudes that have ever walked the face of the earth have been Mexican. And this is a celebration of that on this night.
I want to talk about media rights and media partners. I believe you have a current deal that's worth about $1.5 billion. And the UFC will have an opportunity to renegotiate, add new partners next year. What do you project the price will be next year? And who would you consider as partners?
Yeah, it's going to be interesting how this plays out. I mean, we could end up being like the NFL and other sports where we could be on multiple platforms or just one. I don't know how that's going to play out. But, yeah, we're in those talks now. And to be honest with you, a lot of those potential media people will be at the Sphere this weekend.
Yeah, they'll be watching everything live. So this is a question from someone who hasn't really sat down to watch UFC. But I think about boxing and how, that's just kind of one part of what you do. But it's a very niche sport now. It used to be the most popular sport on earth, and then it became kind of a niche sport that you can only access through pay-per-view. How are you going to position the UFC so that it grows beyond a niche sport?
Well, if you look at the way that you do that is you reinvest in the business. And that's what we've done since day one. Every time boxing puts on an event, it's like a going out of business sale. They try to grab as much money as they can and run. They never reinvest in the sport till recently. Now, Sheikh Turkey out in Saudi Arabia is probably the biggest investor ever in the history of boxing in a short amount of time. But one of the things that we've always done is reinvest. Now, when I grew up, there was Channel 3, Channel 5, Channel 8, and Channel 13. Then when I was in high school, we had about 33 cable channels. over the next several years, I believe there's going to be a channel 3, 5, 8, and 13 again, but globally. And I always dreamed of a day where I could put on a fight and the entire world could watch the fight at the same time. What's the ceiling on this thing? 8 billion people in the world. So I'm going to continue to go into markets I've never been to. We're looking at Africa next year, and continue to build the live events, the sport, and build the business.
Are you, Dana, I do have to ask you about a competition. Obviously, there have been some upstarts here that have tried to sort of take some of your market share out of UFC here, and some of them have done well. I'm curious as to whether you worry about some of those leagues or whether those end up complementing what you're trying to do at UFC.
My first question would be, who's done well? And then my answer to that would be, there are always going to be people trying to compete. There's no barrier to entry to this. Anybody can get involved and anybody can try to do it. I don't ever think about that, about what other people are doing or what their plans are for MMA in the future. I focus on what I do. I know what my game plan is for the next 5 years, and that's all I care about.
All right. Dana White, really enjoyed speaking with you. Dana White is CEO of UFC Ultimate Fighting Championship. And of course, they're going to have a big show at the Sphere, which up until this point, Romaine, as we've talked about, really only hosted musical acts. Yeah. All right. Let's get a clear eye of what could potentially move the markets here over the next 24 hours. And we start off in the morning, 6 a.m., bright and early, Scarlett, with some economic data. Yeah, NFIB small business optimism. Tom Keene likes to call this the small business pessimism survey. But we'll get a read on how small businesses are feeling, especially with inflation definitely moderating, but the employment picture turning as well in a negative way. All right, and with an eye on big tech, and more importantly, an eye on everything that's been going on with chips, executives from AMD, Texas Instruments, and Intel are scheduled to be on Capitol Hill tomorrow for a Senate hearing. Yeah, and we'll see how this goes. They're going to discuss the company's compliance with export controls aimed at blocking Russia's access to U.S. technology. And of course, that's just one of the many issues in the semiconductor industry. So expect a lot of grandstanding from the folks in Congress. You say, all right, after market, we do get some earnings, including GameStop. GameStop, I mean, do they have earnings to speak of? Well, they're going to have a report that lets you know their financial condition of the most recent quarter. Dave & Buster's also scheduled to report. And, of course, a big presidential debate, the first presidential debate between Kamala Harris and Donald Trump. Yeah, this will be taking place in Pennsylvania and Philadelphia. And we know that David Gura will be there. Both sides have been preparing for this for days. Yeah. And this is really the first chance that we're going to see them together. And, of course, what's impressive or interesting about this is Kamala Harris has never met or talked to Donald Trump before. All right. Well, there you go. All right. Well, those are your big events here for tomorrow. Unfortunately, we do have to end the show on a somewhat sad note. We have learned that the actor James Earl Jones has passed away. This, according to Bloomberg, has now confirmed this. That James Earl Jones, of course, most people know, of course, from the voice of Darth Vader, the voice of Mustafa. But we all go back, of course, to his early days, Scarlett. And actually, it was like kind of like public theater in Michigan, where he started playing Othello. He was a huge stage actor out there, eventually made his way to Broadway. And for some folks of a certain generation, he was the quintessential deep voice actor. Absolutely. Yeah. He dies at the age of 93. Again, Darth Vader, Mufasa, also the voice of CNN. So many of us grew up on his voice. Yeah, I forgot about CNN. Just a giant in the industry, James Earl Jones, passing away at the age of 93.